Investing is like having your money work for you. Over time, the money you earn from your investments can far outpace any money you would earn from a salary. In this video, I'm going to talk about what you can do to achieve this. If you're new to the channel, my name is Dan. I'm a business school professor focused on accounting and finance. The goal of this channel is to help everyone save and invest their money better to help build their wealth. So there are three basic ways to build your wealth. You can earn more money from your job, you can save more money, and you can earn more from your investments. Now for most of us, earning more money from our job is going to be pretty hard to do. Outside of the occasional promotion, the money we get from our job is pretty much fixed. And if you work an hourly job, you can definitely work more hours, but there's obviously going to be limits to that. So that leaves saving and investing. Now you can save all the money you want, but because of inflation, your money is going to become worth a little bit less each passing year. So you're going to have to save and invest. So unless you're earning an extremely high amount of money from your job, for the most of us, we're going to have kind of a second career in investing. Investing is a lot like trying to build a really big snowball. All you need is a little bit of soft snow and a really big hill. What I mean by that is you need a long time for your investments to grow. This can be hard for a lot of people to understand, and I've often seen people give up on investing after just 1 or 2 years. Most of us just aren't very excited about putting $1,000 into an investment account and turning it into $1,050 the next year. I'll give you an example that shows the importance of sticking with it. Let's say that every year you want to put in $5,000 into your retirement account. And let's say that you can earn the average return on the stock market roughly over the past 100 years of about 8%. So if you do that, after the first year, you're going to have $5,400 in the account. Of that amount, you only put in $5,000. So you made $400 for free. After 2 years, you're going to have $11,232, of which you put in $10,000. So at this point, most of us look at that and say, most of this just comes from me saving my money. My investments are hardly earning me anything. But again, because of the miracle of compound interest, the growth is exponential. So after 15 years, you're going to have roughly $146,000 in the account. Of that amount, you only put in about half, $75,000. After 30 years, you would have about $611,000. And you only put in $150,000 over the years. If you don't touch that money earning 8% is going to produce $45,000 for you every year. If you like the content so far, please hit the like and subscribe buttons. It helps me quite a lot. So once you've decided you want to save and invest your money, what are you going to invest in? Because if you just put it in your retirement account, it's just going to be cash. It's going to earn nothing, right? My recommendation is going to be stocks. Historically, the stock market has produced an annual real return of about 8.4%. By real return, I mean this is the return even after accounting for inflation. Naturally, the next question is, which stocks do I buy? And how long do I hold them for? My answer is, buy everything and hold it forever. What I'm trying to say here is that while the stock market as a whole has produced an annual return of about 8.4%, there have been tons of companies that have gone out of business, earning their investors a negative 100% return. Okay, so let me elaborate on that. You want to put your money into a fund. So you got mutual funds, you got index funds. But with either type, you're essentially putting your money into hundreds, if not thousands of different companies. So all you're doing when you do this is really betting on the stock market. You are betting on the economy. You're assuming that over time, businesses will make money and therefore you will make money. This is one of the first principles of investing, diversification. So you are well diversified. You don't really care whether Coke or Pepsi takes market share from the other one. You make money as long as people drink soda. And if we see a big industry shift where people move away from drinking sodas, you're still going to make money because you also own Whole Foods. The other thing about these funds is that you yourself don't have to manage them. You don't have to make the decisions on when to buy and when to sell. Okay, so I'm on TIAA-CREF's website, which is a very popular retirement services company, and I'm at the screen where you pick your investments. Let's look at the equities. These are all funds you can choose from. And you can hover your mouse over it, it'll pop up details. And you can also see the gross expense ratios for each fund. A very important piece of information, guys. Over time, the higher the fee ratio is, the more that's going to hurt your total return. So which fund do you choose? My recommendation is to pick one of the low cost funds. Those fees really do add up, and the low cost ones are usually index funds. The reason I highly recommend you put your money into an index fund is that finance research has shown consistently that index funds earn higher returns than mutual funds in the long run. Now, this may sound very surprising since a mutual fund is a professional money manager and they charge a fee which is only a teensy bit higher than the index fund, but it is true. If you're curious about why it's true, check out the video in the description below. Okay, so you've decided you're going to save your money, you're going to invest it, and you're going to invest in index funds. That is great. Now what's next? Well, the next step is easy, but it's actually hard in practice, and that is to sit back and get rich slowly. When you invest, you're going to find that your biggest enemy is yourself. If you don't believe me, check out this chart from a JP Morgan study they did. The average investor earned 1.9% annualized return. Less than inflation, guys, compared to the stock market in general, which earned a 5.6% return. It's an amazing chart, right? How is it possible? Well, in my view, there's really two emotions you have to watch for when you're investing, and those are fear and greed. So we all know how to make money in the stock market. All you have to do is buy low and sell high, and you'll get rich, right? Unfortunately, fear and greed make it more likely you're going to do the opposite. You see, when stock prices start to fall and you see those red numbers on your account, you start to have fear. How low can it go? I better just take it out now and get what I can. So we tend to sell low. The opposite is true when prices go up. When you have a stock that's gone up a lot, you have a big unrealized gain in your account, you got those nice green numbers in there, it's pretty unlikely you're going to sell it. Why would you sell something that just made you rich? We actually tend to do the opposite. As the price of stocks goes up, we tend to want to put more money into them. One reason for this is called FOMO, fear of missing out. We'll often look in the rearview mirror and look at last month or last 6 months returns and say, wow, that was great, but you know what? It could have been more. I have more money. Let me put the rest of my money into the market right now. So look, if you want to avoid sabotaging yourself, the best advice I can give you is to stop checking on your investment. Okay, most of your investments are going to be in your retirement account. You're not going to need that money until you retire. The stock market earns a fabulous return in the long run, but that's in the long run. The reason it earns such a great return is because stocks are the riskiest asset. That's one of the principles of finance, higher risk, higher return. From 1926 to 2019, we've had 25 years in which the stock market produced a negative return. Now look, is a year a long time? It is if you check your account every day. And just recognize you're human, you are not a robot. No matter how rational and logical you think you are, you get a dopamine hit when you open your account and you see that you've made money. You also get a negative reaction when you open your account and you see that you've lost money. And just remember, guys, if anything, when the market starts to go down, that is the time to buy more because that's when you'd be buying low. So sometimes it's helpful to remember that stocks aren't just pieces of paper or letters that come on a screen. They are businesses. Now, just because the stock market's open every day and the price changes every day, that doesn't mean you have to do anything about it. You own these businesses, they're making you money, just sit back and relax. Okay, that's all I have for this video. I hope you guys enjoyed it. If you did, hit that like button.